We are coming to the end of Project One. Yay! I'm sure everybody is excited, just as excited as I am, although I have to admit I'll be more excited once I get them corrected. So if if you note on a bright space, what shows the last assignment here is cash flow and balance sheet. I don't even put income statement on there because if you look at the income statement, it's just all white cells, both the first year and the second and third year. That's not to say you shouldn't look at those and make sure that they make sense, but there's nothing that you'll need to input on those. Now the balance sheet's all uh, white cells as well, but there are a couple changes that we're going to have to make there, partly, not partly, entirely because I had you make a change on the amortization period, and I'll show you where to do that on the balance sheet. So this should be a relatively short presentation. There's only a few things that you need to do to get this tidied up and turned in, and for me to be able to correct it. And if you listen closely to this, you should be able to do it all correctly without too many problems. So in the cash flow, again, we've got a year one, and then we've got, it says 1 through 3, but it's actually 2 and 3, it should read. And you'll note there's only 4 rows that even have orange cells, so the rest of them are white cells that require no change, but again might require your observation to some extent. So additional inventory, yeah, if you have a service business, obviously you have no inventory, so move on, right? And for most of us, we aren't going to need to put anything in here, okay? The program automatically assumes through your cost of goods sold and whatnot that your inventory is replenished as you sell it, okay? That's kind of built in. And so the only time you'd add, maybe this additional inventory is if you thought in, maybe the end of the first year you're going to add a new product line or something to that effect, or in the second year, bounce ahead there. You might be adding a new product line, or for some reason your business is going to explode and so you need more inventory. You'd put that in there, maybe in a month or two. It's not something that you would typically add to every single month. Again, keep in mind that as your sales grow, your cost of goods sold grows, and the program kind of takes that into consideration. So the only time you're going to do this, add any inventory, is if there's some exceptional reason, okay? So that's line 1. Most of you will probably just leave that blank. This one, nobody can leave blank. Okay, owner's distribution. This is where you pay yourself. Remember back in the payroll, year 1, and I said we don't pay owners here. And more of a teaching moment than anything, that this is you will, in all likelihood, all have pass-through entities, or non-Schedule C corporations. Schedule C corporations get taxed twice, whereas pass-through entities, which are partnerships, sole proprietorships, LLCs, LLPs, typically get taxed not at all. Okay, all the profit or loss gets passed through to the owner or owners. Okay, and so you don't pay yourself a payroll, rather you give yourself an owner's distribution. It's basically money that you're taking out of the business. Okay, so this should be something for everybody. Now, important thing here is to come down here, and you got to see your net cash flows, your operating cash balance, your line of credit drawdown. Let's hope that you don't have a line of credit drawdown. And what's that mean? Well, the program says that if you happen to not have adequate cash flow in a particular month, it will automatically grant you a line of credit. That's not terribly unusual. Okay, banks, as a banker for 20 years practically, I can tell you that we made a lot of money by financing those lines of credit for businesses, primarily in our area for farms and ranches. As you might expect, they have a lot of cash needs during the growing season, and so you'd lend them money, and then when harvest was finished and they sold their product, they'd pay you back. And so we would get those lines of credits. And some of you might have seasonal types of businesses where that could make sense. But for most of you, we'd like to see that be zero. But the important thing is, if it's getting too big down here, this bottom line, I'll give you an example. So if I'm going to pay myself $2,500 per month, we'll just do for a few months, you can see that my line of credit balance is just going to keep increasing by that 2,500. Now it's going to increase by the interest that's accruing on there. And so I don't want these dark, bold numbers down here, and you might have it for a few months. And if it's for a few months only, that might be okay. But the important thing is let's just say, I'll pay myself $2,500 for a couple months. I don't really want to. I was going to try to find a spot here where I can show that I make some money. Well, it might ruin my program here, but I can cancel out. So anyhow, if I get to month 4, let's just say, and I have, well, I made a loud noise. Sorry, I better unprotect my sheet, right? And so in month 4, let's just say I make cash sales of $8,000. That should flow down here, okay? Now I still have this line of credit balance, but I also have nearly $8,000 in the bank, right? Because the only thing that netted out of there was this $34 in line of credit interest. And so what I want to do here is I don't want to have cash in the bank and still owe the bank. That doesn't make any sense. I'm going to pay them interest, $34 a month. I mean, it's a wonderful job if you can get it as a banker, but you guys don't want to be paying that if you don't have to. And so what you do is come to this line where it says line of credit payments. And in this month, I've got more than enough to pay it back. All I have to enter then is that $50 or $5,000, $5,050 that is this number here. Okay, I'll hit enter. It goes away. And you can see my line of credit balance then for the rest of the year goes away. Again, you need to check it and make sure that it does go away if you have adequate cash flow. If this is a growing problem down here, if this continues to grow and you don't have adequate cash to pay it off, then you've got a problem with your projections, right? Your sales forecast may be too low, your expenses may be too high, your payroll may be too high. Okay, it's one of the easiest things for me to check and see if you've got that kind of a problem. I'm going to email you back and say, we're going to have to do some adjusting here if we're going to make this business profitable or at least have a positive cash flow. Okay, I'm going to delete these and then we'll go on to dividends paid should be 0. Okay. The only entities that would pay a dividend would be a C corporation. Okay. The rest of you're going to just take it out as an owner's distribution. So if you want to have a discussion with me about your business paying dividends, let me know. I'm happy to have that, if you happen to be a C corporation. It's not possible. Years 2 and 3, same things. Okay. The main thing that's going to occur on here is your owner's distribution. Just make sure that you put something in there. Otherwise, you'll get a note back from me that says you got to have an owner's distribution. Just kind of follow along. Try to make sure it doesn't exceed what your cash flow will allow. And, same thing. If it does, check your line of credit. Make sure that you're not getting a line of credit that's growing. Then we might have some problems. So years 2 and 3, though, make sure you do that. Make sure you get the owner's distribution all the way through that. Okay. Income statement, just check. The main thing here is going to be the bottom right-hand corner. If you're losing a little bit of money that first year, a few $1,000 or something, it might be okay if in years 2 and 3 you start to turn a profit. That's not unusual, actually. That's almost something that we'd expect in a business plan. So, but here's the things that I always watch for. One is a huge negative. Obviously, I kind of go, that's kind of crazy. We can't have that. That's just not going to work. But 2, sometimes a huge positive makes me just as nervous. It's maybe a pie in the sky type of projection that I might mention and make you go back and do a little recalculating. So, just kind of look at it and see, does that kind of make sense? Does that sound kind of reasonable? Does it look kind of reasonable? That's it. That's all you have to do for the income statement. Look it over, make sure it's reasonable. If not, you may have to go back and make some adjustments. Then we get to the balance sheet. Okay? When you're done so far, if you've done everything right, the first year should be balanced because it should be the same as your starting point. Shouldn't really be any difference on it. And if your starting point's balanced, so if this isn't balanced, the first place to look is to go back and look at that starting point, right? Make sure that you got it balanced, that it says just exactly that. You're fully funded and balanced. Okay. Your second and third years, if you've done everything right to this point now, they should say that you're not balanced. Should be big, ugly, red letters there that you're not balanced. I'm going to go back and get rid of this. Okay. What happened to make it unbalanced is going to be in possibly, for sure, in these 2 cells, possibly in these 4 cells. Okay, so prepaid expenses and other initial costs, and you'll see number or numbers here. Again, if you've done things correctly, the numbers that show up here are going to be the exact same as how much you're off when you get down here, when it says that you're not balanced. Okay, and the reason for that is because I had you change that amortization period. I had you change it from 3 to 1 because 3 just didn't make sense to me for most small businesses. Does not make sense that you would amortize your first year's costs over the 3 years, especially some of those costs like prepaid insurance and some things like that. But that we kind of get into some accounting things there and tax things that for another class. At this point, all you need to do is come up here, go to these 4 cells, 2 cells for sure, 4 cells maybe, and delete the contents. Okay. Again, you got to unprotect the sheet. 1, 2, 3, 4. Okay. Delete those contents and scroll down, and at that point you should be balanced. That's it. That'll get you home. These green ones, you don't have to do anything. Take a look at them though. I mean, this provides you some kind of interesting information, a lot of the ratio analysis and whatnot that we like to do when we do the analysis of different companies. So take a look at them, see what you think. The cost of goods sold calculator, most of you didn't use that, would be for manufacturing, amortization and depreciation. It kind of tells you what's going on there, which is definitely an accounting and tax thing that you do, that we all do if we have any kind of a business, ranch, rentals, those types of things. So that's it. I'm going to quit now. That assignment's going to be due here, in a week or so. Everybody have a happy Valentine's Day, and we'll talk to you next week.